Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 26th of May 2020. And yesterday we published a video entitled Next Move for Equities, Up or Down? And on Sunday, as US-China tensions mount, is global recovery at risk? Now in Sunday's video we addressed the issue as to whether the growing tensions between the United States and China, as well as the West with China too, could lead to a further deterioration in global trade already affected by the recent pandemic. In yesterday's video, we highlighted somewhat differing opinions between experts as to the future direction for equities and asked the question, will markets rise or fall? Now, we thought we had, at least from the analysis presented, made clear that our view is that equities may indeed grow stronger short term, as the lockdowns ease and the stimulus pumped into the economy starts to take effect, but that longer term we shall see repercussions in the form of inflation further down the road, and any short-term market euphoria somewhat undermined then. Perhaps we did not make that point clear enough, as some subscribers have asked us about this. Now that said, we are cautious as to how high these equity markets will go, especially as investment advisors are suggesting caution, and alternative asset classes such as gold, in order to hedge and protect against currency devaluation, are recommended instead. Now, we won't go as far as to say that the US should expect hyperinflation, as Mike Maloney has suggested in a recent video, as we believe that inflation can be curtailed for quite some time. Policymakers, quite frankly, currently have to really grapple with the prospect of deflation first, before they even need to consider hyperinflation. However, bearing in mind that for highly indebted governments, inflation is positive, in that it erodes the value of debt, and whilst they can exercise low rates with some inflation, the debt burden becomes less onerous over time. Mike, we suggest, is looking at this purely in an Austrian economic black and white term, and perhaps is not aware of all the tools at the disposal of central banks and governments, of which there are still plenty, and more than they would have you believe. Yes, hyperinflation is indeed very possible with small countries and what we term banana republics, but with the world reserve currency also tied into a basket of other major currencies, this is more difficult to achieve, or another way of putting it, easier to control. Remember, in broad terms, inflation means the rising cost of goods or the devaluation of your currency, which has the same ultimate effect. If all currencies devalue by similar amounts, then parity is maintained, and therefore one has to worry about demand pull inflation. That is, people ordering more goods than can be produced. And this, we suggest respectfully, is very unlikely for the foreseeable future. So, after yesterday's holiday, let's take a brief look at how markets are performing. The time of publication of this is 1100 hours GMT plus 1, and of course the figures may have changed by the time this is published. The Euro Stoxx 50 is up 23 points at 2,994. The FTSE 100 is up 82 points at 6,075. The DAX index is up 81 points at 11,472, and the CAC 40 index is up 62 points at 4,602. Asia Pacific markets closed up between 1 and 2.55%, the latter, the 2.55% rise, being the Nikkei index up 529 points at 21,217. Now, a Bloomberg article published just a couple of hours ago quote the following. Bloomberg article dated 26th of May, 9:42 a.m. GMT plus 1. Headline: UK stocks rally as lockdown easing provides retail relief. UK stocks rose after Prime Minister Boris Johnson outlined plans for the reopening of outdoor markets, car showrooms and shops in England next month, providing relief for retailers that have been forced to shut down in an effort to control the spread of the coronavirus. The benchmark FTSE 100 index rose as much as 2.3% on Tuesday, outpacing other major European gauges, with airlines and travel stocks among the biggest gainers on optimism about travel restrictions easing in some European countries and retailers rising after the government's announcement. UK stock markets were closed for a public holiday Monday, while Europe's benchmark stock 600 rose 1.5% that day amid a bailout for Deutsche Lufthansa AG. Consumer stocks rose after Johnson said Monday evening that England's outdoor markets and car showrooms will be able to reopen from June the 1st, as soon as they're able to meet the coronavirus guidelines to protect shoppers and workers, while all other non-essential retail outlets will be expected to be able to reopen from June 15th if the government can control the spread of the virus. UK car dealership stocks, including Pendragon plc and Virtue Motors plc, jumped. Lockdown has caused considerable damage to the UK consumer economy, Shore Capital analysts, including Clive Black, wrote in a note Tuesday, calling the reopening plans a relief for non-discretionary retailers. We expect calendar year 2021 to be one of stabilisation at this stage. British mid-cap stocks also rallied, with the FTSE 250 index gaining as much as 2.9% to the highest since April 30th. For sure, we can see that equity markets are beginning to benefit, and the openings have not even happened yet. And yes, we have to watch to ensure they do not get ahead of themselves. Now, one of the consequences of what has occurred in recent months is the toll taken on sterling. And again today, Bloomberg has a comment to make about this. So let's take a look. Bloomberg article dated May 26th. Updated at 8:11 a.m. GMT+1. Headline: Pound traders may be facing choppiest June since Brexit vote. The pound is heading for this year's fourth monthly slide, and a lengthening list of risks is pointing to more turbulence in June. Sterling traders look set to face heightened uncertainty on multiple fronts next month. The end June deadline to extend the Brexit transition period, the possibility of negative interest rates in the UK, and the economy's tentative exit from the pandemic lockdown. That suggests the market will likely break with a trading lull typical for the time of year, with volatility possibly scaling highs unseen in June since the 2016 Brexit referendum. Sterling has slid almost 3% versus the dollar this month to around $1.2240 on Tuesday, falling in May for the 11th year in a row. Much uncertainty hangs in the balance around Brexit and the end of June, said Neil Jones, head of foreign exchange sales to financial institutions at Mitsuo Bank. Uncertainty generally pushes volatility higher. A June to watch. Pound action may be the most suspenseful since the Brexit referendum. The current Brexit transition period finishes at year-end, which means Britain and the European Union have only until then to forge a new trade deal in order to avoid tariffs and quotas. The other option is to extend the interim period, and the last date to do so is June the 30th. Talks between negotiators resume on June the 1st after this month's discussions made little progress. Unwillingness to extend the transition period would leave negotiators with the tall task of cobbling together a trade pact, a process that often runs into years in a matter of months. That would only heighten concern that the two sides may part ways without an agreement. Sterling volatility will likely rise on such a prospect, as well as any move to extend the transition, albeit not to highs seen during the peak of the pandemic turmoil in March, according to Mitsuo Jones. Domestic political noise in the UK could also fuel fluctuations in sterling. Dominic Cummings, Prime Minister Boris Johnson's most powerful advisor, is under attack over claims he breached lockdown rules. Cummings will make a statement to reporters and take questions at 4 p.m. The pound may also see wide fluctuations around the Bank of England's meeting on June 18th. Money markets are already pricing in the prospect of sub-zero UK interest rates by year-end after recent comments by Monetary Policy Committee members suggested the central bank isn't ruling out the possibility. And by the way, we have provided details of this in a previous video. That prospect sent 2-year UK bond yields to a record low below 0% last week. According to Bloomberg Economics, negative rates probably won't be a game changer for the economy, and a more potent policy mix may be for the Bank of England to continue with asset purchases, complementing government fiscal stimulus. Option traders see lower risks for a drop in sterling. I think an extension to QE is in the price, but negative rates would still increase pressure on the pound at this point, said Jane Foley, a senior foreign currency strategist at Rabobank International. Should the UK become the next major nation with negative interest rates, the pound could also face pressure from the options front, where risk reversal suggests that traders have stayed less bearish compared with the spot market. The gauge, a barometer of market positioning and sentiment, shows that overall downside risks still prevail for the UK currency. The latest data reveal the depth of the economic damage from the COVID-19 crisis, and investors will be on the lookout to assess the impact of the easing restrictions on the rate of the spread of coronavirus in the country. For Rabobank's Foley, expectations for pound swings next month should have been higher already as Brexit news is back. Given that Brexit tensions look set to rise, as well as political pressure on the government over its handling of COVID-19, it is almost inevitable that we will see further volatility and downside pressure on the pound into June, she said. End of article. Now, for those living and working in the United Kingdom or who invest in sterling, this suggests one thing: higher gold and silver prices, or proportionally higher compared with the US. Now, we can see, though, that gold is taking a small hit and is down $12 since its Friday close, and it stands currently at $1,724. Silver, however, is up 11 cents since Friday's close, mainly because, of course, analysts are pricing in a potential uptick in silver demand for industrial purposes. However, the situation in sterling terms is that silver is down 9 pence and gold is down £26 since Friday's close. So, what can we glean from all of this? Well, we're in a fluid situation. As businesses reopen, we can expect positive equity markets, but as they tend to move months in advance of expectations, unless the figures continue to be buoyant and improving, then these markets will fall back, and quite quickly. Of course, gold particularly will be under pressure during this time, and silver will be less so, adversely affected as the industrial demand begins to pick up. The issue, however, of course, is that if there is a further lockdown due to a second virus outbreak, then we may very well see markets fall considerably. And if not, if that doesn't happen, then we have to be patient for the after effects of the incredibly high levels of money printing. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. Not forgetting, of course, we update our Richard and Greg channel every few days, and we've placed a video in that one yesterday for your viewing and hopefully pleasure. Until tomorrow. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.